It feels like common sense, right? If a government needs more cash, just raise taxes. Seems simple enough. But what if I told you there's this tipping point where hiking taxes actually makes the government lose money? You heard that right. And that's the bizarre puzzle we're going to unpack today.
Okay, so picture this. You're in charge of a whole economy, and you are staring down an absolute mountain of debt. What's your first move? Your gut instinct? You've got to increase your income. And when you're a government, that almost always means one thing. You guessed it, raising taxes.
And hey, this is not just some hypothetical scenario. Back in the early 2010s, this was the cold, hard reality all across the Eurozone. You had countries facing these massive deficits, getting all this pressure from international bodies, and they responded with austerity. And a huge part of that playbook was, well, hiking taxes.
And this quote, it's actually from the very research we're exploring today, and it just perfectly captures the official thinking back then. The logic is laid out crystal clear. Increase tax rates to boost tax revenues. I mean, on the surface, it sounds completely sound, doesn't it?
But what if that conventional logic has a massive, gaping blind spot? What if, once you get past a certain point, that entire strategy doesn't just fail, it completely, totally backfires?
And this is where we get to the core idea for today, the Laffer curve. Now, it's this economic theory that basically says the link between tax rates and how much money the government actually collects isn't a straight line. Nope, it's a curve. Think about it. At a 0% tax rate, the government gets, well, zero. Obvious. But at a 100% tax rate, you also get zero, because why would anyone bother to work, right? So the magic number, the sweet spot, has to be somewhere in between.
And this visual here, it shows it perfectly. See, on the left side of that hump, as tax rates climb, revenue goes right up with it. But then, you hit the peak. That's the revenue maximizing point. Once you cross that line, you're in what you could call the danger zone. Any tax hike from there on out, and your revenue actually starts to drop. So, why? Why does this happen? Well, it's basically a tug of war between two different effects. First, you've got the arithmetic effect. That's the simple part. If you tax a slice of pizza at 50 cents instead of 25, you make more money on each slice sold. Easy. But then the economic effect rears its head. It's the part that says, hey, if that tax gets way too high, are people just going to stop buying pizza? Or, maybe they'll start making it at home, completely off the books. And that is the fundamental trade-off. Okay, so it's a really neat theory, for sure. But the billion-dollar question is, does it actually happen in the real world? When you look at the cold, hard data, is there really a tipping point?
Well, to find out, we're digging into this fantastic piece of research from 2014. It's a dissertation from a business school in Lisbon, and these guys didn't just talk about the theory, no, they crunched the actual numbers for the entire Eurozone to see if these curves were real. So here's what they did. They took years and years of data from all across the Eurozone. They looked at direct taxes, stuff like taxes on company profits and what you and I pay on our income. And they also looked at indirect taxes, like the value-added tax, the VAT, that's tacked on to most of the things you buy. And they really zeroed in on the three big ones: corporate income tax, individual income tax, and that VAT we just mentioned. Why? Because together, these three make up something like 90% of all government tax revenue. So if the Laffer curve is real, this is where you'd expect to see it. All right, let's get to the good stuff, the findings. First on the block, what did the data show for the tax on company profits? And right away, a twist. When the researchers looked at the Eurozone as one big single entity, they couldn't find any evidence of a Laffer curve for corporate taxes. Actually, they kind of found the opposite. It looked like, for the bloc as a whole, higher corporate tax rates didn't lead to lower revenue. But, and this is a big but, lumping all those very different economies together was actually hiding what was really going on. As soon as the researchers started looking at it country by country, a much different story started to emerge. Now, check this out. The study calculated the perfect revenue-maximizing tax rate for a bunch of countries. And for places like Portugal, Greece, and Spain, the very countries at the heart of the debt crisis, their average corporate tax rates were already higher than that calculated sweet spot. The implication here is just huge. It means they were probably on the wrong side of the curve, literally losing money by taxing businesses too much. Okay, so that's the story for corporations. What about the tax people pay on their own paychecks? Well, for the Eurozone as a whole, the researchers found a super clear tipping point. The number they calculated for the maximum revenue rate for an individual income tax was right around 31%.
Okay, now hold that 31% number in your head for a sec, and just look at this. The optimal rate is there on the left. Now compare that to the actual average rates in places like Belgium and France during that period. We're talking well over 50%. The gap between the ideal and the reality is, well, it's just massive.
So the conclusion here was just unavoidable and, frankly, pretty stark. The study found that pretty much every country in the Eurozone was taxing personal income at rates so high they were almost certainly getting less money than they could have been. They were deep, deep in that prohibitive range of the Laffer curve.
You know, this is one of my favorite visuals because it's where you see the theory just slam into reality. On the left, that's the clean, perfect curve you'd see in a textbook. But on the right, that's the curve the researchers actually built using real-world tax data for Portugal. It's a little messy, it's not a perfect arc, but that shape, it is unmistakable. And you can see that peak, that revenue maximizing point, hitting right around a 49% tax rate. The theory was holding up in the real world.
Okay, so finally, we get to our third big tax, the value-added tax, the VAT. This is basically a tax on stuff you buy, a consumption tax. And with this one, the story completely flips on its head. Get this. The optimal VAT rate for the Eurozone was calculated to be almost 35%, but the average rate that countries were actually charging was just under 19%. It's the total opposite of the income tax situation. Instead of taxing too much, governments had a ton of room to increase VAT and bring in a lot more money.
So let's pull all this together. What's the verdict? Well, first, the Laffer curve isn't just some abstract theory. The data shows it can be a very real thing. Second, that tipping point is not a one-size-fits-all number. It's totally different for corporate, individual, and consumption taxes. And maybe most critically, this research suggests that during that whole debt crisis, many European governments might have had it completely backward. They were likely losing revenue by taxing work and income too much, while at the exact same time leaving money on the table by taxing consumption too little. Which, leaves us with one last, really big question. This study was great, but it used historical data to find these tipping points after the fact. So if economic data can help point to that sweet spot, why is it so incredibly hard for governments to actually hit that mark in real time? That is something to chew on.